what are we showing here? So in at the first part of the year, coming into the year, so you can see there I've circled the end of last year. Believe it or not, the world was expecting 6 rate cuts. This is what was priced into the curve: 6 rate cuts coming into the year. There were some brokerage firms that were very vocal about this, very confident that we were going to see these rate cuts. Goldman Sachs was one of them, and Goldman Sachs apparently today has deferred their first cut now to September. They were holding out for June. Now they've just moved that to September. And look where we are today, just 1 rate cut priced in now to the curve for 2024. What a crazy world. Just 5 months ago, the world was expecting 6 rate cuts, and this was the whole reason why everyone was so bullish on U.S. equities. And what's been the problem since then? Let's go on to the next. Well, the problem since then is that we've had entrenched inflation and interest rates have stayed higher. And so one of the problems that's going on is that we're, as you recall, more than a year ago, we started having bank failures because of rates being too high. Now there's very serious problems, continuing to happen in the commercial real estate industry, and this is the second largest. This is the second largest private commercial REIT. That Blackstone, the B REIT, was the largest. This one's called the S REIT. It's a Starwood Real Estate Income Trust that was founded around the same time as Blackstone's. Several years ago, when interest rates were let next to nothing, and investors were excited about the 5% or so yields that these commercial real estate funds offered, and so this is the second largest. The B REIT is the largest. These commercial real, and they're not just invested in office properties, by the way. These are industrial properties. There's homes. There's industrial and apartments. These are broad commercial real estate funds, and they are having trouble. This one is facing continued redemption pressure, and its lines of credit are running out. They've had to halt investor redemption. So there's a line to get money out of this fund, and the fund has had to put up gates. So this is, I mentioned this because a number of or a few clients of ours and friends of ours who are in the commercial real estate industry, and also run, similar commercial real estate projects, they're really concerned about this. And there's definitely been a shift in sentiment towards, not just offices out there, but commercial real estate at large. Let's go on to the next. So what's the problem? Why have interest rates stayed higher? Why can't the Fed ease as everyone has hoped? Well, it's because the price, inflation remains entrenched. This is just looking at the price of everything that has to do with your car. Okay, insurance rates are up substantially, but since the pandemic, here's just one area of inflation of CPI that has become entrenched, and it's everything to do with your car. Anyway, I thought that was kind of an interesting chart. Let's go on to the next. So what we've seen is that supercore inflation, this is one thing that the Fed pays particular attention to. It has started rising again. And so coming into the beginning of the year, supercore inflation had been trending down, and the Fed thought that it was on track to continue trending down to get to that magical 2%, long-term inflation target that they have. Well, here we are, we're back up. It's trending back up again all year, and we're back close to 5% on supercore inflation. This is a major problem. This is the primary macro thesis that we have had at Crescat for several years now, and everything still points to this thesis of why We believe we are going into a new stagflationary environment, why rising inflation is entrenched, and how we're still in this bubble market for large cap growth stocks. I mean, this is the most speculative stock market environment that I have ever seen in my career. I think it's probably the most speculative market going back to 1929, and I'm talking about meme stocks, Magnificent Seven stocks, cryptocurrencies, and everyone believes that the Fed is going to be the best friend of markets and keep everything alive due to lower interest rates, and yet the Fed has had to keep rates super high, and this is causing problems, major problems, like bank failures that we had last year. So Barry Sternlicht, who runs Starwood, has been on CNBC and Bloomberg talking about how there's going to be more bank failures, and now the news story comes out from the Wall Street Journal this week about the S-REIT having problems, his Starwood S-REIT, and there you go. So we are, there are substantial problems in the market, and Tavi's going to have a great chart on economic versus surprises versus inflation surprises coming up here. But this is the problem. We see a stagflationary environment, and there's so much still to unfold because of this. Let's go on to the next, my final chart. 50 years of returns comparing gold to treasury bonds. Okay. What's going on here? We've been, for the last 40 years, until very recently, we've been in an environment where bonds have been strongly outperforming gold, and bonds are had been the safe haven trade. Well, what this is showing, this is the breakout in gold relative to treasury bonds, showing, and it's funny because Tavi has a chart from probably a year and a half or 2 years ago where the Wall Street Journal had a headline, an article about, front page article about how gold was no longer a safe haven. And that literally, I think marked the bottom of gold relative to treasuries. And here we are now with gold breaking out on a 50-year chart relative to treasuries. Gold is the safe haven, we believe, not treasuries, especially now with the debt, the deficits, the entrenched inflationary pressures.